Alrighty, alrighty. Let's see. Let me get the YouTube page up. I guess I'm going to have to refresh that. Page up. I guess I'm going to have to refresh that. There we go. Turn that mute off there. Are y'all hearing any background music? For those, let's see, top chat, turn that to live chat so I can see everybody. And are we live? Somebody type in the chat for me, whether you're on the Bullish Bears YouTube on the main chat or here in, okay. Am I streaming? Cool. All right. Let's, we're going to pause this background music. I don't know if you guys are hearing that, but here we are. Coming back around. Oh, there's a bit of a delay. I see that. Looks like there's about a 5-second delay between my mouse. Let's keep that kind of in mind. Welcome, everybody. It's for posterity services. It is Tuesday, March the 5th, 2024. My name is Marziti, and we are going to be doing an intro to price action and patterns. The general format that basically you're wanting to do here is I've got a series of about 6, 7, 8 slides, something like that. And then at the end of each slide, so I'll go through the slide, then I'm going to take questions at the end of each slide. We move on to the next slide and repeat. Then, so we're going to do interactive questions as we go through this. And then at the very end, time permitting, we're going to go look at some charts to see, you know, some of these patterns in action. Beyond that, this is a 1-hour presentation, and you know, it may be that I'm going to try and keep it very much there to keep everybody on schedule with things. So this is a very lightweight introduction kind of thing. Wow, is my mouse really that slow? Look here, I'm moving. Where's my mouse? Oh my gosh. I'm at the left side of this blue box here, and I'm moving my mouse right now to the right. And, oh wow, it's kind of slow. So I don't know if the audio's behind or not. So anyway, if we'll get through this. Let's see what happens. Without further ado, Intro to Price Analysis and Strategies, Part 1. This is a 4-part series, and we're going to do one part tonight. Part 2 will be on Thursday. Part 3 will be next Tuesday. Part 4 will be next Thursday, and then we're going to start it all over again. And the reason we're doing that, we've got a lot of new people coming in. We've got new people coming into the Bullish Bears community. We've got a lot of new people that are coming in asking questions. And certainly, you know, this is one of these things that the evening stream is advantageous because a lot of people work during the day. And we've got folks that are West Coast that it's just, you know, for them, a lot of times for them, it's just too early to join the morning stream or for whatever reason. So we're going to throw this 8 o'clock one on. All right. So let's see. Oops, back up. We got to start with the standard disclaimer and the legal here. This is a presentation that I put together. I am not a financial advisor. This is for education purposes only. I am not an administrator, or nor have I any position with the Bullish Bears community. I'm not compensated for this video. The stuff that I say here does not necessarily represent their opinions and so forth. In the end, regardless of what we talk about here, you're responsible for your own trades. You're welcome to use my video for reference and stuff like that as long as credit is given. All right. Which strategies work? Here's the biggest thing you got to understand about strategies. Everybody's got a strategy. Everybody, if you go onto YouTube and you put in day trading, you're going to see 5 million people that come out there and say, oh, here's my RSI strategy, and I made $10,000 last month doing it. And here's another person over here saying, I use the TTM squeeze. And everybody's got a strategy, and they all want you to think that their strategy is the best one. Well, the answer is all strategies work sometimes. Would you believe there are people that actually trade based on astrology? And you may think that's cool. You may think that's crazy. But the question is, well, does it work? Well, it works sometimes. Sometimes. All strategies work sometimes. Believe it or not. But no strategy works all the time. You can go ask all the professional traders you want to. Ask all the professional traders you want to. None of them got a 100% win rate. None of them. Some of them go as low as 60% success rate. You say, well, how could you be successful with that? Because they got huge wins when they win. And it dwarfs all their losers. But no strategy works all the time. We want to find a strategy, though. So, I mean, if there's dozens of strategies out there, we have to ask ourselves, well, which one's right? And the answer is the one that makes sense to you. The one that makes sense to you. And here's the thing. You're going to study a lot of strategies in the very beginning. And I want you to. I want you to study the RSI, and I want you to study price action, and I want you to study the squeeze and the supply and demand and the linear regressions and all that kind of stuff, because you'll never figure out which strategy is right for you until you look at all of them. Look at them, and then what you're going to do is you're going to look at a blank chart, nothing on it, and I want you to tell me, do you see it? Do you see a strategy? Does something stick out to you? Look at a blank chart, and a strategy jumps out to you, and you're like, I found my strategy, the one that when I look at the chart, I see it. It's in my mind. And that is your strategy. A strategy. Now, granted, most of us learn 2 or 3, 4 strategies. But the point I want you to see is that you're going to have to find something that makes sense to you. If you really want to see something crazy, go look up... what's it called? Itchy something or other. I don't know. Ichimoku. Go look up what an Ichimoku cloud looks like, and you're going to be like, oh my God. It is the craziest looking thing. Now, some people know how to trade it, but most people will look at it and think it's something from a mixture of Time Warp, Star Wars meets Star Trek looking kind of thing. And you're like, what? All right. But some people can use it. I can't. Okay. So we're going to look to identify a strategy. Next, we're going to backtest. Now, what is the difference between backtest and paper? So backtesting is going back in time. Maybe you've got some kind of a replay. If you're on Thinkorswim, you can use the on-demand. If you've got TradingView, they've got the replay feature and stuff like that. You don't actually have to buy the stock or the future or whatever like that. You just have to say, okay, I would get in here, advance. Okay, I would get out there. And you back test your strategy, however it is you do it, to see, are you getting the mechanics of it down in your head? Are you getting the mechanics down? And then, once you kind of got the mechanics down to it, we're going to look then at paper trading. I got this highlight pen. Let's use that. Then we're going to come into paper trading. Now, different people have different opinions. Some people say skip paper trading, go live with a small account. You can do that. But here's the thing to understand about trading. There are 2 parts. There's your strategy, and there's your emotions. And you see, when you are back testing, that's all logic. There's no emotions to that. And when you're paper trading, well, you may have a little bit of emotion, but you got that safety blanket of knowing it's not real. Now, I'm a big fan of paper trading because I work out the mechanics of it. The mechanics. And I think Signet talked about the fact that he was studying EMAs, exponential moving averages, and their crossovers and stuff, and he spent 6 months doing that. And But now, he's a master at it. But the point being, the beauty of paper trading is you can work on that muscle memory. Get in here, sit, wait, whatever, blah, blah, blah. Get out there. And then you can fine tune. Here's I've got a secret for you. Now, you can call it a secret if you want to, but here is the real deal about profit in trading. It is not where you get out, is where you make your profit. It's where you get in. It's where you get in, because if you learn to get into the trade at the right place, and you have a good target, and you reach that target, you get a predictable amount of profit. Predictable amount of profit. But you'll see, this candle took off. It's going to the moon. I can't sit back and wait for this. I got to get in on this. And you jump in there and you hit that buy button too, and that candle goes up. Wait a minute, turn around. What happened? And we call that, chasing a candle. We call it FOMO, fear of missing out. So the first thing we want to do is, in my opinion, like I say, if we paper trade, we can see if it actually would work or not. All right? So we back test, we paper trade. And you say, well, when do I leave paper trading? There's a very famous trading psychologist by the name of Mark Douglas. And he has videos on YouTube called Mark Douglas Trading Psychology. And he's old. He's an old dude from the 1950s kind of thing. And these videos are old, but what he says is still 100%. Trading should be mechanical, not emotional, mechanical. If you listen to Kevin when he streams in the mornings, what does he say a lot? Being patient, being patient, being patient. And you're sitting there thinking, well, do something, dude. No, it's not his trade. It's not his setup. He's got his strategy. He's going to follow his strategy, and he's going to sit there and see it from the beginning to the end. All right? So we're going to paper trade until you are fairly consistent with doing it on paper. And then we're going to start small account. If you listen to Jeremy, he talks about opening up a TradeAvate account with $300 in it. And he gets it up to $2,000, $3,000, $4,000. And then he drops it back down to $300. You don't need thousands upon thousands of dollars to get into trading. $300. Okay? You can start small. And another advantage to starting small here is your emotions get the softest hit because you've done the mechanics of it, right? You have done the back testing, you've done the paper. Now by starting small, you've now got your mechanics down. Now you're starting with your emotional side of trading. And because it's a small account, if you blow it up, it's not the end of the world. You can handle it. Then you can grow your account and grow your account as your emotions get used to the trade, right? Now, all that being said and done, let's beware of the rabbit hole. And the rabbit hole of other systems is this. You are studying a system. Let's say it's supply and demand. It's fine, whatever your system is, but I'm going to use supply and demand for the moment. You're studying it, you're really getting into it, you're getting in the groove, and then you see a YouTube video, and this guy's like, you know what, I made $10,000 using the RSI strategy here, and you can do it too. And you're like, well, I'm not getting that great results on supply and demand yet. Maybe I should go learn the RSI strategy. Maybe I should, No. Test a strategy. Paper trade it if you like it. Paper trade it and whatever. If you don't like it, fine, go look for another one. But if you do like this one, forget what anybody else is telling you about their strategy. Because then all that time you spent to back test and to paper trade the one strategy on, you just throw it away. We don't want to do that. Test a strategy out from beginning to end. Okay. Now that leads me on to, let's see. I need to stop and pause for questions here real quick before I go to this slide. I'm looking at the YouTube comments here. Has anybody got any questions that they want to pop up into the YouTube here? And I'm also looking at the main channel here for our Discord folks. And if you've got any questions, you can pop them up over there as well. And I'll give that just a second. Okay, let's move on then. Buyer beware. Caveat emptor. as they say in Latin or whatever. Gurus on YouTube, Twitter, and X, and all this kind of stuff. Let me talk to you for a minute about a legitimate service and a non-legitimate service. A legitimate, now, I have been in this business for a while. I've been through all kinds of services. I've spent, me personally, I've spent thousands of dollars on different services when I was in the beginning because I didn't know any better. I did not know any better. I came in just like everybody else, and here's some guy saying, take my training course here, and you can learn to day trade. Oh, really? Okay. I'll give you $350, okay, for your training services. And I learned something that I could have gotten for free on YouTube. Then there was, you got to follow the news. You got to follow the news. Absolutely, positively must follow the news. So I signed up for some of these news services, and they didn't do anything for me. Well, then I got into another one. Where's my mouse? There it is. Then I got into, if you pay me $50 a month, I give you access to my Discord group, and when I make a trade, I will post that trade in the Discord, and all you have to do is follow my trade. $50 a month. Okay. Didn't sound like a bad deal until you realize you're not going to learn anything. That whole saying there, teach a man to, or give a man a fish, you feed him for a day, teach a man to fish, you feed him for life kind of thing. Well, if you just take buy and sell services, alerts, then you're never learning anything. And if they quit streaming, what are you going to do? Kind of thing. You need to learn and take your own trades and be responsible for your own trades. There are legitimate services out there, but here are your red flags. Your red flags, first of all, are they asking for a lot of money? Do they actually provide any statistics on what they say that they are offering you? In other words, if they tell you that they have a buy-sell alert service here, do they actually give you a real spreadsheet showing their wins and losses? If they don't, why not? If you really have a system that works, wouldn't you want to tell everybody and show them the proof? So we don't, this is the beauty of, now I grant you, not everybody can come to the 9:30 Eastern Time morning stream in our Discord group. I get that. And of course we also stream a lot of it on YouTube as well. I get that you not everybody can come there, but we do it. Kevin and Jeremy and Creedmoor and these guys are in there. They're streaming in the mornings, and you get to actually watch them make live trades. And if they lose, we watched one moderator, I'm not going to call any names, but we watched one moderator who's a bigger scale trader, lost $5,000 in one day. Now, he's a big scale trader. He's a big time trader. So to him, that wasn't that big a deal. It's a lot of money to me. It's a lot of money to you probably. But, he lost on live streaming in front of all of us because he's not perfect. But then again, you can also see Kevin and doing his supply and demands, and you can see Jeremy with his linear regressions, and you can watch his trades right there, and you can watch them win, you can watch them lose, you can watch them. They have a higher win than loss rate. We see that on a regular basis. So just be mindful of these services that come out and promise you things. Question here says, are one-type strategy traders possible? Yes. Yes, you can be a one-type strategy-only trader, but you must be patient. And you have to pay attention to the screen. Meaning, I used to trade a strategy called the TTM squeeze. It's a good strategy. It's fine. And it has to do with called compression. And actually we'll see some other things that are kind of related to it later on. But anyway, the squeeze is the idea that if stock prices really compress between their highs and lows compared to the rest of the day or whatever, that they get wound like a spring, and eventually they got to bust out of there and take off either north or south. And it was a good strategy, but you got to be patient. You got to be patient. Now, I mean, you can scan maybe you're scanning 5 or 6 or 7, 10 stocks in hopes that one of them will go into the squeeze today, but they may not. And if you're okay with that, fine. One strategy is fine. There are some people, though, that, for example, there are some people that they only trade earnings. They only trade earnings. No earnings, they're off doing something else. And they're not interested in anything else. They don't want to day trade. They want to trade earnings. Fine. So, yeah, you can be a one strategy trader. You just have to just realize that you just kind of have to wait for the setup to occur. If you learn multiple strategies, the odds of something happening in one day are a little bit greater. But I would rather you sit on your hands and not trade anything, just trade that one strategy. I'd rather you trade that one strategy and make money than to lose money trying to trade three strategies. It's okay. It's your money. It's okay to not take a trade. It's okay to not take a trade because if it's a bad trade, you saved yourself some money. All right. Any questions on this one? Okay. I'm not seeing anything, but I know there's a delay between my speaking and y'all hearing. So give it just a sec. How am I coming through? Are you guys seeing me okay? Or seeing my slides and hearing me okay? Somebody type into the chat somewhere and let me know what's going on. Okay. Thank you. Thank you. Yeah, there is a delay, so I'll just have to keep that in mind. Not sure what's going on with that. I'll have to talk to Kevin about that. All right, moving on. Let's get into some actual stuff here and understand. I'm going to try and give you a little bit of history on why these things are the way they are. If you are new to trading, and some of you probably are, some of you, now granted, some of this is, like I said, a lot of this is going to be elementary if you've been trading already. But if you're new to trading, I want to talk to you about why things are the way they are. And so I'm going to start, if I can find my mouse with this stupid PowerPoint. There it is. Let's talk about, I've actually got these in the, we'll start with resistance. There it is. There's my mouse. This is resistance. And we can see what happened here. Price came up and rejected. Price came up again and rejected. And we ask ourselves, well, what's going on here? And what's going on here is that people were willing to buy it. Yeah, I'll buy it. Yeah, I'll buy it. Yeah, I'll buy it. I'll buy it. I'll buy it. No, I ain't paying no more for that. I am not paying any more for that. That's as high as I'm willing to go. Well, then some people sold it off. Then some people said, well, let's buy it again. Let's buy it again. And they got up here and they says, I'm not paying a dime more for it. And this is where the crowd as a whole says, no, we're not going to do that. That is overpriced at the moment. Well, then they sold it way off, and everybody took profit that bought up here, and then they sold it off or whatever kind of thing. Maybe a lot of people went short up here, and this is what you'll see a lot of times, is that when the market realizes they're not willing to break that line, and they see it here, they say they're not willing to break that line, and there's a good chance I will not get stopped out. So I'll short. And well, it worked. These people took it short all the way down here. Then when that was exhausted, these people, the other group, started buying it up again. And again, a third time, not going any higher. And we call that resistance. But again, the important thing is to understand what is happening here. Here on this first candle, they said not buying it anymore. Then we come to the second time around, and these people saw this and says they're not willing to go any higher. I'm going to short it. And look how it plays out. So there's your trade opportunity for you. Now, third time, would you say third time's the charm? Maybe, maybe not. You know, I could see doing it on the second time. The third time is up in the air, as we'll see over here in resistance. Or support, rather. So this is resistance. It's resisting us going higher. This is what we would call support. A support shelf or support area, support line. Price came down to it, and people says, no, I'm not going to sell it for a penny more, or less, rather, a penny less. So it got bought back up. Then the people tried to sell it down again, and a second time, what are we saying here? If we take what we learned over here, we could say it didn't break it. This could be a good long opportunity, and there it goes. right? Then eventually, though, they try to bring it back down again. And this time, look at the size of this candle. Does this tell you that they meant business this time? They meant business, and now it doesn't always do that. Sometimes it just goes across a little bit at each time. But this candle clearly tells you right here that they meant business to push it down. Now, ironically, it did come back up. But these are the short sellers. These people got in up here, and they were selling it short, and they were determined to get this price as low as they could. They did. They made a fortune, and then it comes back out, and they're out of the trade. See that? So, support and resistance. Do we break support and resistance? Eventually. We always break it eventually. Always break it eventually. We don't necessarily know where or when, but we always break it eventually. Anyway, questions or thoughts about this? All right, let's move on. I'm kind of giving like a 10-second buffer since there's a delay between things, but let's talk about Kevin's favorite trading strategy, and that is supply and demand. What were the colors, he asked. Let's go back a slide and take a look at that. On my chart, red is it closed lower. Green, it closed above, it's open. Blue for me means it is an outside bar. What does that mean? An outside bar means, you know what, let me get the, hang on, how do I clear this? Here. Notice that the top of this blue candle took out the top of that green candle. So it went higher than that green candle. And notice that the bottom of this blue candle went lower than that green candle before it. So we would call this an engulfing candle, because that word engulf means bigger than before. So on my chart, I've got a special thing here that just a special highlight thing that shows me when we also call this an outside bar. So blue for me is an outside bar, also known as an engulfing candle, but it just simply means that it completely overtook the candle before it. As opposed, this little white candle, you'll notice that the top of this white candle was less than this candle's high, and the bottom of this white candle was higher than this candle's low. So it's totally inside the shadow of this green candle, and we call that an inside candle. So on my screen, if you see white, it means it's an inside candle compared to the candle before it. If you see blue, it was totally bigger, higher and lower than the candle before it. Okay? Yeah, I should have mentioned that before. I'm so used to it, I forget to mention it because it's so used to me, and it would be different to you guys. I get that. So I'm glad you brought that up. So, all right, any other questions about this before we move on? Cool. All right. Supply and demand is Kevin's favorite strategy. And you'll know that if you've ever watched Kevin trade, he will literally sit there and wait. I mean, sometimes he will go ahead and jump in. But for the most part, Kevin will just sit there and wait until price hits his targets. See the question in the Discord group about how to set up those special candles. When we go to the live chart, remind me if I forget. I'll show you how I do it on my Trade of 8. I will do that when we get over to the live chart. If for some reason I forget, please remind me. So supply and demand. Let's talk about supply and demand for a minute. You have to have patience to use this strategy. I'm just going to be honest with you, but it pays really well. It pays really well. And the reason being, let's talk about what's going on here. Now, I'm going to ignore this particular one right here for a moment. What I want you to notice is that price is going up. And it's kind of like that support and resistance we saw earlier. Remind me. One sec. Remind me. Forget. Okay, so back to supply and demand. Just like that support and resistance thing, although it may or may, you may or may not see an actual support and resistance line here, but the idea is that people were willing to buy it, they were willing to buy it, they were willing to buy it, and they just simply came a point where they just said, I'm done. I'm not willing to go any higher. The thing to understand here, this is not necessarily like the thing that we want to see that makes this a supply zone is typically this big move afterwards. And what that's kind of telling you is we come into supply and the market says we're not going any higher. In fact, we hate this price so much that they just slam the price down. Now, you don't always have this big candle here. Sometimes you just simply have a candle, which my drawing is horrible though, but it's got a huge wick and then the prices go down from there. And this kind of tells you they tried to push it up here and the market kicked them all the way back. Different ways you can mark it out. Kevin's a master at doing it, and he's got videos on our site on how to do supply and demand. Feel free to check those out. The point being, though, is that what we know happened here is the market says, no more. We're not going higher. And so it comes back down, it comes back down, it comes back down, it comes back down, and people are selling it off until we reach a zone where the people says, no more. We're not going lower. We're not going to do it. This is as low as we're willing to go. And look at here, we got these big candles here rejecting it, showing this big movement. Here's one right here also, showing this push away with a vengeance or whatever from this lower demand area. And where did it go? Where did it go? Well, it went back up here. Well, what's up here? People that are willing to sell. There are people selling up here. And as you can tell, I don't have that beautiful little mouse pen thing like Signet has. And people down here that are willing to buy. So these people are willing to sell up here. And so when the price comes up here, the sellers take control and they short it down. And, well, it made another rally there. And again, for the third time, we're not going there. We're not, here was the first time, here's the second time, third time. Take a hint, we're not going there. Where did it go? Back down to here to where all the buyers are in the demand zone. Now, eventually, all supply and demands get broken. They always do, just like support and resistance on the previous channels. And here we are. We did eventually break it. But this, like I said, this is a strategy you've got to be a little bit more patient for. We watch here, we see that happen. Then we see this come down here. So we've identified a supply, we've identified a demand. We see the chart came up into supply and you say, well, I guess I'm supposed to sell it here. Where does your stop go? It goes just on the high side of it. You sell it down here. And then when you get down to here, you get out of the trade and you say, okay, now I'm going to go long. I'm going to trade it the other way. Okay, where's your stop go? Just down here. And you go up here and, whoa, we broke through the supply, man. We're going on. Okay? But what you're going to see is that the stocks a lot of times, or I say stock kind of loosely, but it could be futures, contracts, or whatever. We're saying we kind of see that there's this, for a period of time, people are not willing to pay more. Thus, you have a supply zone, and and then they're not willing to sell it for any less, and we have a demand zone. Now, eventually, it breaks. We see that here. But this is supply and demand. You can identify it. Kevin, like I said, is a master. He's got a variety of videos on it. And we'll talk, perhaps after the chat or whatever, after things, we can go more details about it. But again, like I say, Kevin's got great videos on it. Feel free to check those out. Any questions about the general idea of why supply and demand works, or whatever's on this chart? Moving on to the very next slide. Here we go with standard deviation. Okay. This is one of Jeremy's favorite setups right here. This is called a standard deviation. Now, I'm going to first talk about this white line. This white line here on this chart, I set up, this is the average. You know, if we say that if we add 2, what's the average of 2 and 4? You'd say, well, 3. 2 plus 4 divided is 6, divided by 2 is 3. That's the average. Well, in statistics, that same word is the mean. M-E-A-N. It's called the mean. Average. Same thing. So let's say that we go back. We're on the daily chart here. I'm going to try and write this out. Day. Okay. We're on the daily chart. And I want to find the average for the past, no, wrong, sorry, 252 days. What's so special about 252 days on a daily chart? Because there's 252 trading days in a typical year. 365 calendar days, but 252 trading days in a calendar year. So I want to look back 252 days, and I want you to tell me where the middle. Take the highs and the lows and all that kind of stuff and find me the middle, and that's what this white line is. And we call that white line the linear regression. That is the average of what's been going on for the last 252 days. Where's the average? All right. Now, if we know where the average is, and if you've taken statistics, you're going to hate what I'm going to say because I'm going to round things and get over it. But if we say, okay, if that's the middle, well, then we're going to talk about something now called a standard deviation. Like I said, you standard deviation people, they're going to say, well, one standard deviation is 68%, but I'm just going to call it 70. Get over it. This is what this green line means. This green line says between this green line here and this green line down here, this range, is that price will be within this range 70% of the time. And if you look at the chart, just kind of look at it from left to right, you can see that 70% of the time it stays inside of those two green lines. Actually, I drew my arrows completely wrong, didn't I? They're supposed to be inside the green line. Inside. Ugh. Inside the green line. Okay. This red line right here is a half a deviation. That's a half. That's one deviation. The blue line out here is 2 standard deviations. This one here is 1. And so we say that between here and here, whoops, too far, there, price will stay in that range approximately 90% of the time. Okay? And again, if you look at it, well, in this particular case, it never even breaks outside the two lines. Actually, I think it's 95%. I could be wrong. 95. It is 95. Let's kind of 95. You ever try to take a pencil and just completely write over the number underneath it and hope you can do it? You know, never mind. All right, 95% of the time, price stays between 2 standard deviations. So really what you've got is from this line here, it's one deviation this way, one deviation that way, 1 plus 1, 2 standard deviations. And price stays in there. Well, okay, great. What is that? Who cares? Well, notice what happens. See here, we hit 1 standard deviation over here. What happened? It went back to the mean. Huh. Well, it chopped around, and it went down here again to the 1. And what did it do? It went back to the mean. You say, wait a minute, wait, let me see if I understand this. You're telling me that if I went short here, there's a good chance, because we said that approximately 70% of the time it will go back, that it'll stay in these channels, and it'll go back to the linear regression. So, okay. You could do that. You could do that. Now, should you trade away from the linear regression? Now, that's more advanced. That's definitely more advanced. And, I'm not going to get into that on this, but you say, well, what if the price goes out to here? Can it go out to here? Well, of course it can go out to there. But it doesn't have to. The odds are in your favor that you've got roughly a 70% chance that it's going to come back here, or at least back inside here. It may you see how it chops around in here a little bit, and it may do that for a while. But notice, if you are selling, if you shorted, you're still making more money from versus where you got in, even if it does chop around on that green line for a while. So kind of notice the direction that you're trading there also. But at any rate, so linear regression, the middle of the range of where it trades. Deviations are the statistical probabilities of where it goes. Again, there's no guarantees that any of these work. All trading patterns fail and stuff like that. But it is something that you might want to study. Related to standard deviations, and I'll try and write it out, but it's something called Bollinger Bands. Well, that's supposed to be an N. Bollinger? Anyway, bands. I got to get me one of those pens like Signet has. Bollinger Bands. It's kind of related to this idea as well. So they're kind of related. All right. Any questions about standard deviations, linear regression? And if you're a statistician, get over it. Okay. All right. All right, then. I'm not seeing anything pop up here. Okay, well, let's see. Are there any pros that use this strategy? Absolutely. It's called a regression to mean. I'm glad you brought that up because I don't know that I actually said the phrase. Regression to mean is the strategy. And so I'm going to type that in. If I can spell regression to mean strategy. Yes, there are people that, because it's purely statistical, it's purely mathematical. Some people just love pure mathematics about trading. And the truth of the matter is that, a lot of your professional traders will tell you trading should be mechanical. It should not be emotional. If you look at the odds and the odds are in your favor, then if the odds are in your favor, then there's better. You should take the kind of trades if the odds are good enough, kind of thing, because the odds are in your favor. I'm stumbling over my words here, but you understand what I'm saying. I hope that regression to mean strategy is a very common strategy. A lot of people do it. Also, they, as I was trying to miserably type into the thing here, but Bollinger Bands is a related, I just typed that into the YouTube over there, Bollinger Bands is a related type of strategy that you can look at, and you'll see, and they're very similar in what they do. The difference being is that Bollinger Bands, for their center line, they use a moving average instead of a linear regression. But beyond that, they're very, very related, very common to each other. So, any other questions? Oh, wow. It's already a quarter of. I'm going to give this just a second to see if anybody's got any other questions. Here we are. Oh, yes. Oh, you know what? I'm going to like my own video. Oh, that's just wrong, isn't it? I mean, no, I'm going to do it. It's for the algorithm. Oops, too far. Okay. All right. Sorry, hit the mouse there. One last strategy. We're running a little bit behind because I'm running my mouth too much. So let's just go here to the fair value gap then. All right. You notice when we were talking about like supply and demand, and I talked about that big rocket candle away from price, from that high price or that low price. These things, and when we were talking about, yeah, that was supply and demand. So notice here, what I want you to notice here, we're going to talk about what's called a fair value gap. This is part of what's called, commonly today, the idea has been around for a while, but this was what was made famous by a guy, and I completely lost his name right now, Michael something or other, who has a strategy called the inner circle trading, ICT. Most people just say ICT. Well, his strategy basically was he noticed, and apparently other people have used it before, but he made it kind of the popular idea. Notice right here that we have this inside candle, and I'm going to call this candle number 1 candle. We have this white inside candle right here. Actually, it's not white. Anyway, whatever. Looks kind of white though, doesn't it? Strange. Anyway, then we have this red candle right here, number 2. And then we have this other red candle right down here, who is candle number 3. So the first thing I want you to realize, the fair value gap takes 3 candles. Now, what I want you to realize is that the low, I should say, the low of this candle number 1, candle number 1 is here. The high of candle number 3 is here. And you say, so what? They don't overlap. Look back here. This candle here overlaps with this one. The candle as a whole, not just the thing, but there is a little bit of overlap between these candles. And there's an overlap between these candles. All these candles overlap except for, here's one, here's a gap right here. There's a gap. But all these candles overlap each other, maybe just by a tiny tick, a tiny point, but they overlap. But this candle and this setup here and here, they don't. Here's another one right here. There's a gap. And here. Well, let's take a look at what happens. So what's happening here? Well, what happens is that price was moving along, blah, 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 and then a news event or something happens. And for whatever reason, Huddleston, thank you. Michael Huddleston was the founder of ICT. Jeremy's just typed that in to me. And you gotta get used to listening to Michael Huddleston talk a little bit there. He's pretty proud of his system. I guess that's okay. Anyway, I'm sure he's a fine guy. I mean, no disrespect in any way. But anyway, the point being is that for whatever reason, everybody just said, sell, sell, sell. And this candle rockets down with such velocity that there were a lot of people still in this range right here that they never got a chance to sell. Their orders never got filled. They're still willing to sell there, but the price isn't there for them to sell. So there's a gap. There's a gap of people waiting to sell in this case. Well, what happens? A lot of times we see this happens. The price came back up here, and these people are now finally able to sell. Well, look here. We've got some gaps here on these lefts, and what happened there? These people were able to sell, and this gap, then this gap got filled, then this gap got filled. This gap was filled effectively because everybody was happy enough for it left. Although it did come back, and that can happen, you say, well, if you were going to go short here, where's your stop go? Well, it goes up here. Now, the same thing happens going long, kind of thing, if this was flipped upside down. And like I say, we're running a little bit short on time, but I'm going to hopefully get in a few charts and we'll look for some of this kind of stuff. The point being, in a fair value gap, it's a target. And I want to very, very, very quickly, very, very quickly talk about targets. So I'm going to go through this very rapidly before we go to charts. Not only do we see support and resistance here, but if you were going long here, where would you set your take profit? Target. Just a little bit below the target. You know you've got a good feeling it's going to hit this yellow dotted line. I'm going to take it just before, just in case. Targets. Trading is about strategies and targets. Targets, 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 targets. Get that word, beat that word into your head. It's all about, if you get in a trade, you need to have a target to tell you where to get out of the trade. You need to plan the trade. You'll hear Kevin will harp on this every morning. Plan your trade, plan your trade, plan your trade. He's right. You need to know where your target's in. Jeremy shows his targets there with his lines as he sets up, whether he's using linear regression or fan lines or whatever it is he's using. Targets. They're targets. You've got to have a target. You just don't get in because you think, well, I think it's going to go up. No, we don't do that. That's crazy. You have a reason to get into the trade. You have a target. Supply and demand. What are these? Targets. Okay. Oof. Hang on. Where's the thingy to? There it is. Erase. If you short this, what's your target? The linear regression line. Now, some people will argue that if it hit green on one side, it's destined to hit green on the other side. Maybe. And if you're trading, let's say 2 or 3 contracts, you can take one contract off here and your other contract off here. That's great. But it's all about targets, and that's what the thing is about trading. There's when to get in, why you get in, and where are you getting out. You need to have a beginning and ending plan with every trade. Where's your stop go, and all that kind of stuff. All right. All right, I see here, Gord says here, when I scalp, I find my pullbacks with the setup. That's one of the things there that we see. Let me go back. And again, let me clear this off. And you'll see that we know that Jeremy talks a lot about this here, called giving half back. If we take this range right here where we broke, roughly, it went this range, and you'll see that a lot of times if you're a scalper, it gives half of it back. So if you were able to get in here, you've got 2 targets, 1 half back, and 1 that fair value gap. 2 targets right there. So yeah, all kinds of different things. So but while we got a little bit of time here, we'll go look at some charts here in just a minute. Have we got any questions? Let's see. Do you use MAC histogram in conjunction with standard deviation or Bollinger Bands? Okay, so at some future we may get into talking more about indicators. You can, though. I'm just going to very quickly answer you to say that you can use MACD or Bollinger Bands and squeeze indicators and different things like that. Again, that's part of your strategy to back test paper trade to see if it works. The problem with a lot of your MACD, the MACD especially, is it's a lagging indicator. It's historical information. The only thing that is real-time information is the actual chart itself. We will be talking about candle patterns in the future. Here we're talking about these gaps. These are targets and different things. But the main thing, you can use them, and I do from time to time, especially if I'm looking at a longer trend. The thing is that the price action. Now, there's one other thing I'm going to mention to you in addition to price action, and that's called volume. And I'm going to come back to that more towards the end of the series. It's like episode 3, I think. Volume plus price action will help you understand the direction and the move for most people, kind of thing. Some people can just trade pure price action, especially if you're going for small moves or if you're doing supply and demand or whatever and you're willing to wait it out. Indicators, though, are lagging if you're, and again, I'm not saying there's anything wrong with that. You just got to remember that. So you don't necessarily, just because the MACD signal line crosses, that is not a sell signal or buy signal on a SPAC because it's lagging. The move has already started to happen. If you didn't see it in the chart, you should have seen it in the chart first, and the MACD would have confirmed it because it's lagging. So it would confirm it. But you wouldn't trade because the MACD did it first. You would do it because you saw it in the chart and the MACD confirmed it. So, and that's fine in that kind of thing. So just bear that in mind when you talk about any of your kind of indicators. Most of them are going to be lagging. All right. Any other questions? Let me scan through here. Let me just kind of make sure I've hit all we talked about the colors, strat regression, blah, 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 MACD. All right. Let's go look at some charts here real quick. You know what I've completely forgot to do? Completely. Oh, give me 1 second. Let me get... I completely forgot to set this up before we started. Now, at this point here, you can ask whatever questions you want to do. That's fine. We're going to look at some charts as soon as I can get logged in. Let's go over to the simulator. Come on, thing. Hurry up, thing. And as we're coming up to this here, I'll spend about 5-10 minutes looking at some charts, and then I'm going to cut the YouTube off. If those of you in the Bullish Bears group want to continue for a little bit over in the live stream, we can do that. I'm fine with doing that for a little bit. So you see I'm in a demo account right here. And but what I want to do, I'm going to go... So we can hang out a little bit over there afterwards, but I'm going to cut the YouTube channel off here in just a few minutes, kind of thing. So let's go to the ES, and let's get out of this 1 minute charts. Let's go look at 5 minutes. Okay, the question was asked about the colors, and those colors, I'm highlighting that right here, is called LD, Latter Day Trader. Latter Day Trader, inside, outside bars. And what you do is you go to, if you're on Trade-Ovate, you go to indicators, and let's see, we're going to go to explore the community. LATTER dash latter day. There's others. Time and tick countdown, Williams fractals, multicolored MACD if you're interested in MACD, as opposed to the built-in one. Wonder clouds. Oh, inside out by side bars. Right there it is. So So, Melcat, let me know if you saw that in the chat, just so I know that you saw what I just did. If not, I'll send it to you afterwards. Let's look for some patterns here. Now, the first thing I'm going to do is I am going to remove everything. And I want to go back to here. What might we call this right here? Could we call that, you know what, let me turn that, and that off. Can we call that a rejection? Would you say that price rejected? They pushed it up and it rejected. Maybe that there might be a supply zone. Now, how far do I draw the supply zone? Well, I'm going to draw it to where the trend continues. In other words, let me drag this out of the way. The trend was coming down, 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 boop, and then it went back down, down again. So that's the outlier. So for me, if I'm drawing it, some people only draw the wick. That's okay. Some people draw the top of the wick to the open. That's okay. I'm going to draw, whoops, I didn't mean to do that. I'm going to draw, gimme, there. I'm going to draw it to here because this is where the trend continued. This was outside of the trend. And then I'm going to make that, at this time, it was red to remind me that you would sell in that area. Let's move on. Let me check one last thing. Make sure I'm in candlesticks as opposed to Heikenhashis. Does anybody see it? Do you see it? What is this? Fair value gap. Big move down. What did it do? It came back to the fair value. Now, it did overshoot it. But that tells you target. There's you a target. Looky here. What's right here? Fair value gap. What did price do? It came back to it. Target. So if you, for whatever reason, got long down here, where's your target? Right here. There's your target right there. Let's look. What else happened here? What's here? Fair value gap. Right there. It went down. It came back into it. Went down. Typically, you know, when the original ICT strategy was taught, they would say that when you came into the fair value gap, that you would expect it to roll over and go back. But that doesn't work as predictable as it did years ago, but it still makes for an outstandingly good target. Fair value gap. Not filled yet. Another one, candle 1, 2, 3. Right there. Let's just move forward in time and see what happened with all these fair value gaps. There's the fair value gap filled right there. So now let's go look at some supply and demand instead. I want to go to the 15-minute chart. I'm going to clear. By the way, let's see, y'all, if y'all got any questions, type them in. I'm just kind of showing you some stuff here. I'm just kind of bouncing around here while we got a few minutes. Let's go to the hour. I've got about 5 more minutes here before I'm going to cut the YouTube stream of things, but I want to kind of go, see this big move candle right here? Let's call this area down here a demand zone. And I'm going to draw it like this. And I'm going to label it green, which tells me I'm supposed to buy, possibly, if we go there. And what do we see happened? Oh, look at there. Boom. Now, it did barely go outside of it. As you can see, it did overshoot it just a little bit. So you have to kind of bear that in mind with your stops. Nothing's perfect. It's not going to hit, say, well, there's the end of the green line. I got to stop. No, it doesn't. You just kind of have to bear that in mind. But what did it do? It bounced right out of it. There's your demand. Let's see. Can we find a supply on here? Does anybody know what it is I'm looking at right now? I haven't taught this yet. You may already know this. Does anybody see exactly what I'm looking at right now? It is called a head and shoulders. Watch my mouse. Head and shoulders, there's what's called a reversal pattern. Here it comes up. We're bullish, we're bullish, we're bullish. We make the left shoulder. Okay. We make the head. Okay. We make the right shoulder. Okay. So we have two shoulders. These shoulders are not exactly perfect. We love to see them when they're exactly perfect. They're not. Some people, but at any rate, let's see. What happened when price broke below that neck right there? It was a pretty aggressive sell-off candle, wasn't it? Pretty aggressive sell-off candle. Now, it doesn't always mean that it's going to stay and continue bearish forever and a day. As we can see, it's kind of chopping around. It's come back up to that area and it's still chopping, and eventually it went back up north. So you should consider a head and shoulders to be a short-term pattern. We will come back to this. However, what I really am more interested in is here. And you know what? I'm just going to mark the wicks because I'm on the hourly. I don't want them to be astronomical as far as their width. This one I'll go ahead and take part of it because it's not that long of a wick. Come here. There you go. Now let's walk this to the right. Oh. What happens right here? Supply went to demand. Oh my God, no. Yeah, right there. Right there it is. Supply and demand, right there in front of you. Now, what happened here? We broke supply. Well, okay, it happens. Eventually, all supply and demands get broken. All patterns get broken. Eventually. This one got broken right off the bat, as you can see, because we set it here. This one played out, you know, see, we set this here. It went down to there. Perfect, beautiful. Came back up. So you could actually trade this both ways. Trade it, short it, and then long it. Wow, talk about double profits. And when it did re-enter this here, it did kind of break it and so forth, and then it came back through. Okay, so after this, it's broken kind of thing. And I don't think our chart gets that high. Yeah, no, it doesn't get that high again. Anyway, there's some supply and there's some demand. And real quick, I'm out of time here. But I want to go to regression. 252. No, 190. We'll do the 190. 390. 390 1-minute candles in the day. Let's go back to our regular trading hours. Yellow is the linear regression. Here, we hit, look at there, we hit 3 linear regressions. 3, actually almost 3.5. There's 4. We actually went 3.5, but why did we do that? Well, we went into this demand zone. So, okay. Anyway, what happened? We came out of that demand zone. Did we have a short-term target? Right there, back to linear regression. Well, you know, we went up to green. Where did we come back to? Linear regression. Huh? Let's go back the other way. Oh, wait, chart doesn't go any further. Green, yellow, green to blue. Okay, if you'd have gone long here, of course, you would have been stopped out. But, you know, again, it's a probabilities thing. I hope you're seeing that this yellow line right here is the center of where all the action is, and that's where it's coming back to. So, anyway, folks, I have enjoyed doing this here with you guys tonight. I hope you've gotten some different information out of it. And like I said, we're going to do this again Thursday night with part 2. For those of you in the Bullish Bears group, I'll go over to the live stream over there if anybody wants to hang out over there for a little bit. Otherwise, I'm going to go ahead and bring the YouTube to our conclusion, and we will see you guys on Thursday. Good luck, everybody, and good night.